Okay, today's video is going to completely shatter your mind. Like seriously, I'm not even messing around. Like today's video is going to completely transform the way you view the market, because when I really understood this concept and I really understood how to understand what time frames are and really what is going on, that's when things really kind of shifted for me because I mean before that point, I was always confused. I was always like is price bullish, is price bearish, what's going on? And it wasn't until I understood that there is no such thing as counter trend or pro trend. It's all relative based on the time frame that you're looking at. And also that time frames are just a representation, like time frames are just a representation of data or price based on the time frame you're looking at. So for example, the 4 hour is just every candle is a representation of data within that 4 hour candle. But if you were to drop to a lower time frame, this, like for example, this push right here, you can see on a lower time frame or a higher time frame. Now on like maybe like a daily or maybe even a weekly, this is just one candle. And once you get good at understanding that this is what price looks like right now, right? On a weekly, we have a down candle and then we have this tiny up candle. And once you get good at understanding that notion, and you can finally start to see like, okay, I can see everything of price on one time frame. There's multiple trends that are occurring across each time frame. It just helps me to look at maybe like a 4 hour or a daily to better identify the trend. So for example, let me drop to a lower time frame and let me mark this out real quick. So you have this as your swing point on the 4 hour, right? This is bearish. If I drop to say like a 15-minute, I can still see that price swing. So that price swing is from here down to here, right? You can see that this is one leg. And so if I was to zoom out and look at price, I can see the 4 hour on the 15-minute. So you can see the 4 hour is probably something like this. It's going to look like this. It's going to look like that. It's going to look like maybe this and then that and then this. Or it's going to be this and then this. But there's multiple time frames and multiple things occurring on one time frame. So if you go to if you zoom in, right, there's this structure. This is bearish. So what are you expecting? You're expecting price to come back to the edge. You're expecting price to move back here and then go lower and take out this liquidity if the trend is to continue. But what you have to also understand is that within that structure, there's multiple other structures. So there's this structure, right? There's here to here, here to here, here to here, and then here. And now you're expecting price to come back to here and then head lower based on this structure combined with this structure. And then if you even zoom in a little bit deeper, what you can see is what? You see this internal structure, bearish, right? And then boom, boom, lower low, lower high, 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 and then higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. So price is bullish, but price is bearish, and then price is bearish. And so what happens is people get confused about, well, when do I know to go long and when do I know to go short? And that's where it really makes sense to understand time frame is relative. It's all the same data. Like this swing point here, looking for price to go lower, is the same thing as this 4 hour swing point I showed you earlier. It's just easier to see on the 4 hour, but you don't need to go up to the time frame to see it. I personally do because it just makes it easier to find my swing points. But you have to understand that there's multiple things that are in play at one time. You have the daily structure that's in play, right? Daily is bearish. And then within that, you have this, like, you could say like weekly structure fails to go higher and then we break down. So this breaks. So now the weekly is bearish and price is likely to come back to here. Come back to this edge and then continue. Now, again, it doesn't need to do that because that's a weekly chart. That doesn't mean I'm going to wait for a price to get back up here before I want to look to sell. I understand those things are occurring, and I know that, okay, cool. If I know that every time frame is just a representation of the same data, I just need to figure out what time frames I want to use. And then also, you don't even need to switch time frames. You can just look at the 4 hour, like I said, and you know, okay, cool. Where are the odds going to be in my favor? The odds are stacked in my favor. The probabilities are stacked in my favor when I compare multiple time frames or multiple structures together. So you have this structure, or you have this structure, right? This A to B leg, this pullback, boom. That's one. So the price is bearish. And then you also have this structure, which is bearish. And then you also have this mini structure. But then on the lower time frame, you have this little swing. And I can tell that this is a 1 hour or a 15-minute structure. So when you pair those things together, you understand, okay, if price is bearish and price wants to continue its bearish trend, and we just broke structure on the 4 hour, so we broke here or here, what's the next likely thing that's going to happen? Price is going to come back. It's going to hold this high, and then we're going to go lower. So we understand that when price goes bullish on the lower time frame, which can be seen across any time frame, there's this little pull here and then this break, and I know that price is bullish on the 15-minute and the 1 hour because I know how to understand candlestick structure. And so basically what you'll see is, okay, if price is likely to come and pull back, well, then when price goes bullish on this time frame, I'm going to take longs up into this area. But I know that these longs here are short-lived. They may only reach up to like here and then drop because you're going, and then basically the bigger time frame might come into play. So let me break this down and show you in the sense of a trade. So if you look at the 4 hour, the 4 hour is bearish, and then what I said is like the 15-minute is bullish. So what happens? You have price go bearish, and then price breaks here, right? Price breaks, boom, and then price breaks there. So higher high, higher low, higher high, higher low, higher high, higher low. And then what I see is that there's this level here, and I know that price could go short from here. Why? Because the 4 hours bearish. We're likely to go short at some point. It doesn't need to come back here or here. So I am willing to still look for shorts if it makes sense. So there's like a 1 hour buy to sell candle here. I do understand that price went bullish on the 15-minute, but this structure could still be considered bearish. But again, it's all about stacking the odds in your favor. So if I'm not sure, if I'm going counter trend because the 15 minutes bullish, then I'm going to wait for the 15 minutes to go bearish before I want to go taking shorts, because the 15 minutes bullish and the 4 hours bearish. So I want to wait till things are paired together. Now, does that make sense? Like, it's going to be a little confusing until I kind of really show you, but essentially price is bullish here, right? And then I can see on this singular time frame, if I was to zoom in, I can see price went high, low, took out this high, and then we broke down. So I know that on the 5-minute and the 1 minute, this is bearish. And I understand that you can take shorts from here to then head lower, but again, that could just be short-lived. This could just be what? And you literally see what happens right here. This could just be a short just to take price down to this 15-minute zone and then continue higher. Why? Because the 15 minutes bearish. And that's why you want to pair multiple time frames together, and that will help you understand what is going on. So because I understand that price is bullish, and this is the range we're playing on the 15-minute, I know that eventually price is going to come down here and then head up higher and take out this liquidity, or it's going to break this low. So if I understand that and I compare that with the 4 hours bearish, we're tapping into a significant supply and demand zone, and then I see the 5-minute, look at that, see, 5-minute comes up, takes liquidity, and then what? We break to the downside. So I'll be looking at this zone as a supply and demand zone to go short. But then what do you see happens? Price goes bearish. It fails to come back up to the full zone. You have to realize when price breaks, this is actually your supply and demand zone. This is like maybe a 30-minute or a 1-hour block. So price goes bullish, or the last buy before the sell. So last buy before the sell, price comes back in, wants to tap and then head lower. So this is mitigated. So now what you see is price break down, break this structure, and break this high. So I know that price is now bullish again. So why would I want to take sells from here? You don't. And this is where a lot of people get caught out, because again, you're forgetting, yes, like price went here and then now we're bearish and you have this supply and demand zone. But again, what happened with structure? Well, look at the 15-minute or even the 30-minute or the 1 hour. Look how clean this 1 hour is, right? Price is bullish. We tap into a supply and demand zone. What's the likely thing that's going to happen? We're going to take out the high. So it's pairing multiple ideas together at the same time that allows you to execute multiple trades in the market. It allows you to understand that every time frame is just a representation of the same data. There can be multiple trends and multiple structures occurring at once, and that's why it's better to stack the odds in your favor. So if you know, okay, the 4 hours likely to pull back to a higher time frame supply and demand zone, well, then I can take buys. When do I want to look for buys? When price goes bullish. When price is bullish, okay, price is bullish. But I can also look for sells back down into these areas, or maybe down into these areas lower, or it can just continue this bearish trend. Price could just, shit from here. And that's why you still want to look for sells. You got to be able to look at both sides of the market. But again, when price goes bearish, right, we break the high, then break the low. This is your supply and demand zone. Price comes and taps the supply zone, breaks the low, and then we break the high. So now what happened? Price went bullish. So price went bullish after tapping a 15-minute supply and demand zone. Price is bullish on the 15-minute, and we went bullish on the 5-minute. So why would I want to look for sells here? The sells made sense when we were understanding this structure. We wanted to see this back down into a 15-minute supply and demand zone to then go higher, because we understand that this is a structure. We're looking to go higher. We're playing this as a short-term sell. But what happens is people get caught out on this and they'll take this sell and they'll be like, why didn't it just run like 1,000 pips? And it's like, well, because you don't understand that there's multiple structures always occurring at once. And so what you'll see is this plays out, right? And then what you'll see is people will still be looking for trades from this zone, not realizing that this higher time frame structure is in play. So what you'll see is this price went bullish. So now you have multiple time frames aligned with each other. The 4 hour wants to come up to a higher time frame zone likely. The 15-minute is bullish, the 30-minute and the 1 hour is bullish. And again, like I said, every time frame is relative. I'm just saying the numbers to make it easier in your head. But I don't really think of them in terms of like the 1 hour, the XYZ. I mark them with these dots to really understand what structures are being played. And anyway, so yeah, price goes bullish here. So why would I look for sells here? It's a low quality trade. It's unlikely to hold, as you can see, right? This level is not going to hold. Why? Because one, it was already mitigated right here. This is just the refined zone, but the full zone that caused this break of structure was here. And then price comes up, tapes it, boom, takes the low, takes the high. So now price is bullish based on the 15-minute, based on the 5-minute, and the 1 minute. So when price comes up into here, it's very, very unlikely that that's going to be a trade that works out. Sure, it might work out here and there, but until you understand that there's multiple time frames and multiple structures occurring at once, and it doesn't matter, it's just a different representation, then you can understand, well, I can trade any time frame. And you're correct. You could trade the 5-minute or the 1 minute. It's all relative, right? Everything is just relative. So what you could see is, okay, so we would look at structure. We're like, okay, this is one piece of structure. I understand this is probably a 5-minute. And you have 1 minute structure, right? So you have this lower high and then lower low, which breaks this structure or breaks this structure. Then you have this, which breaks that. So this is higher high, higher low. And then you have maybe here's a higher high, higher low, higher high, higher low, higher high. Then price comes and breaks this structure, right? So now we're bearish, and you can look for sells from this area, understanding that what? Price is bearish. Well, where is it likely to be bearish until? Well, it's likely to come down to here because price wants to go higher, right? Price is going to want to go higher and continue this 5-minute trend. And so you take a sell here, boom, -1. Cool, that's fine. Price goes bullish again. So price goes bullish, and you're like, cool, I'm going to look for buys in this area, like somewhere in here. It goes bullish for a short time, doesn't break the high, and then we break the low. So now you're like, okay, price is bearish, and you're like, okay, cool, let me look for shorts. So you're looking for shorts, maybe use this whole zone. Maybe you get this sell here, it goes down, boom, hits your target, boom, and now the 5-minute zone is being hit. And now you're like, okay, cool, boom, we break this structure, price is bullish now. If this had not been here and price just did this, then this is totally amazing. But because price came down, took this low, and then took this high, this is not a valid zone anymore. Price is now playing out this higher time frame liquidity or play. Sorry, that was terrible. Basically, when you expect price to move higher, right? You're expecting the trend to do this, right? And above every high and low is liquidity. So you have liquidity sitting here. What is liquidity? It's just stop orders. So basically, people have their stops here. Like people are buying, and they have their stops here. People are selling, and then their stops here. Same thing. So if price was to continue going higher and you're following the banks and financial institutions, hedge funds, things like that, what you would expect is them to protect their positions, protect the low, protect this low, which means this is, if the bullish trend is to continue, this is your next high. That should be taken out. So therefore, this is liquidity. That's the target. So when you understand that, you're like, okay, cool. Once price shifts structure, so let me just show. So this is your 5-minute A to B leg or movement. Price comes down, taps this zone. We are now looking for buys to come and take out this liquidity. So basically, every other supply and demand zone that was created within this range was just used to propel price back down to here before going higher. So we know that every level is likely liquidity. So would I look for a sell here? No, because I understand that price has fulfilled its expectancy. And the next thing that's likely to happen is to take out the high. So I know that this is likely liquidity, this is likely liquidity, and this is likely liquidity. So every previous supply and demand zone that was used to propel price back down, once we fulfill the expectation, which is to bring price back down to the bottom of the range and then continue higher, everything else just becomes liquidity. And I'll show you this across multiple time frames. We can even drop to like a 15-second. Let me show like a piece of price over here or something. Cool. So if we look at this piece of price, right? Well, we'll just do it from up here. And this is why you can be a trader on any time frame. And that's why there's people that scalp, there's people that day trade, there's people that swing trade, there's people that do intraday, etc. It's all just like what you want to do. So look, for example, look, we have higher high, higher low, higher high, higher low, higher high. So this is one full A to B leg. We know price is eventually going to come back into here. But we also know that there's internal structure. So there's this structure. Maybe this is like a 1-minute leg, and then this is like a 15-second leg. And then look, price comes in, taps. You could take this buy, targeting liquidity upon here. Look, and then we fail. So you get taken out for break even or a small loss. And then price breaks to the downside. And you're like, okay, cool. Are we now bearish? No. You understand that on a higher time frame, this is your leg. This is bullish. So just because we go bearish, you know that that's likely just bearish until here. And if we break this low, then we're fully bearish. And then what? Price comes in and taps this like this. Boom. Taps there. Taken out for break even. And then what? And then you're looking at this zone. And you're like, cool, price is bullish. I want to look for buys here. Boom, you get taken out. Okay, cool. Now price is bearish. Where am I looking to take sells? Within here. Boom, 50% is hit of this full buy to sell leg. Look at that, 50% hit, boom. Price goes lower and does what? It fulfills the expectation of price to take out the liquidity of the low if the trend is to continue. Now price is bearish again, so what are you looking at? We're looking at this. You could enter in here, or what you could do is stack the odds in your favor. Once price taps into the zone, you wait for it to go bearish again, because what? On a 5-second, price must go counter trend or bullish. So therefore you want to stack the odds in your favor. Okay, cool. Let's wait till the 5-second goes bearish. Okay, cool. Price breaks here and then boom, pulls back. You enter here and then bam, you're short. So it doesn't matter what time frame you're on. Every time frame is relative. There's multiple entries across every time frame. It's just a matter of what time frames do you want to trade, and also realizing that the higher time frame moves are going to be more in your favor, because you're going to get, it's not that they're more in your favor. Well, I guess they are more in your favor because they're just higher time frame moves, but you also have a lot less emotional volatility because you compare multiple moves together. Whereas if you're just sitting on the 1 minute and the 15-second, sure, you can read the moves of the 1 minute and the 15-second, but the problem is you're going to get taken out a lot, because look, this is, maybe you take a buy here, right? And then you get taken out, not realizing that this is just part of a 5-minute move, a 5-minute bearish move. You took this buy here and then price just rips through. And that's why I think using multiple time frames with multiple understandings and multiple things, and not even just time frames. As I said, you don't need to use time frames. You just need to understand there's multiple structures always being played at once, right? There's this structure. There's also, these internal structures, and then price now goes bullish. So now I would look for buys here, understanding that what? Price went bullish, and now we're also bullish on the 5-minute. And we're also bullish on the 15-minute. And then look at that. What happens? Price breaks this high, pulls back to this supply and demand zone, last sell before the buy, mitigates, and goes higher, takes out the liquidity of here. You could have easily taken one of these trades, and maybe it's like a 1-5 or a 1-3 or 1-4 or 1-2, whatever. You need to figure out what your strategy is and build a system around how you want to identify trend, how you want to identify structure. And once you understand that, then you'll really kill it in the market. And that's why once you understand that time frames are just a representation of the same data, it's just on different ways of viewing it, different lenses. They are all the same. You can see everything across every time frame. That's when you really start to understand structure and you cannot get caught out. So yeah, anyways, hope this video was helpful. Let me know if you have any questions.